Namaskar dosto, welcome back to the Stock Info. Today we are going to discuss one important subject in our episode 27, the defense and railways. The metric 9 out of 10 investors never check. The complete guide how to evaluate BEL, IRFC, RVNL and every defense and railway stocks you own. In our first section, we shall discuss start with the money, the budget, numbers create scale and legitimacy immediately. India's defense budget this year is 6.81 lakh crores. Railway CAPEX this year is 2.5 lakh crores. Last year, Bharat Electronic Limited secured 1081 crore in new defense orders at a single announcement. This week, railway stocks rides rallied 13.9% on new order win. Every Indian investor has been told buy defense and railways, but here is what most investors do when they research these stocks. They look at the PE ratio. BELP is 38 times expensive, IRFC PE is 17 times reasonable, and they stop here. That is wrong metric for both of these sectors. There is one number that gives you 3 to 5 years of revenue visibility, defense and railway companies. A number most investors have never heard of. It is called order book to revenue ratio. This is episode 27, how to evaluate India's biggest investment theme the right way. Now, why defense and railways are structurally different? Build an investment case why these sectors deserve attention. Most sectors run on quarterly demand cycles. FMCG scales depend on consumer spending, which can drop in a recession. IT revenue depends on client budget, which Accenture reminded us can be cut overnight. But the defense and the railways are different in fundamental way. The demand is set by the government budget announced every February for the entire financial year. Here, when India commits 6.81 lakh crores in defense, BEL, HAL, Bharat Dynamics know their market size for the year. When the Indian Railways commits 2.5 lakh crores to CAPEX, RVNL, IRCON, BEML know their opportunity. This structural demand visibility is what creates order books. The order book is confirmed list of contracts already won, where revenue will be recognized as work is executed. Think of it as a company sales pipeline that is already converted to confirmed orders. For BEL, order book is approximately 3 times of its annual revenue. That means if BEL wins 0 new orders for the next 3 years, it shall has 3 years of existing work to execute. This is why the PE ratio alone is insufficient for defense and railway companies. A high PE may be entirely justified if the order book is growing rapidly. Next, in our section 3, how to evaluate defense stocks. The 4 key metrics. This is most practically valuable section. 4 metrics for evaluating defense companies. Metric 1, order book for revenue ratio, OB divided by the revenue, BLOB divided by revenue approximately 3 times, that is year of the revenue already in hand. The ratio above 3 times means excellent near term revenue visibility. Below 2 times starts to raise questions about the future order flow. The track is every quarter is the order book growing faster than the revenue. If yes, the business is accelerating. Then metric number 2, EBITDA margin stability. BEL has consistently maintained margins of 27%. This is exceptional for the manufacturing defense companies. Margin compression is any quarter for this first warning sign, the cost pressure from the raw materials and insufficient execution. Then metric number 3, order inflows per quarter. Even with the healthy existing order book, you want to see a new orders coming in every quarter. If order inflows fall significantly below the quarterly execution rate, the order book will start depleting. BEL received 1081 crores just last week. That is healthy order inflow. Then metric number 4, indigenization percentage. India's Atmanirbhar Bharat policy is systematically increasing the percentage of the defense procurement that must be from the Indian companies. Higher indigenization percentage for the companies produces mean larger addressable market opportunities ahead. Now, the coming up, railway stocks are completely different business from the defense. IRFC cannot be evaluated the same way as BL. The four categories of railway stocks each evaluated differently. How to evaluate a railway stocks and four categories? Most investors treat all railway stocks are the same. This selection shows they are four completely different business types. Here is what most investors miss about the railway stocks. They are not one sector, they are four completely different business types, each requiring a different business valuation approach. Category number one, IRFC. This is a lending company, not a project company. IRFC raises money from the market and lends it to the railways, Indian Railways, at a spread. Evaluate IRFC like you evaluate a bank in short 49. PB ratio, the ROE, IRFC ROE is 12.47. What PB is justified? From short 49 ROE 12 to 14% suggests PB of 1 to 1.5 times. IRFC's PB is approximately 1.2 times today. That is in the right range. But notice, IRFC is down 35.83% in 1 year. Government backed does not mean safe from volatility. Category number two, RVNL, IRCON, RITES. These are the project execution companies. They build railway bridges, metros on government contracts. Evaluate like defense companies. Order book to revenue is the key metric. RITES rallied 13.9% on July 1st. The new order win exactly the order inflow signal we look for. Then number category 3 IRFC. This is the monopoly consumer facing business, online ticketing, catering, tourism. Evaluate like consumer business, revenue per ticket, uses growth, take rate expansion. Category number 4, Bemal, Titagar, rail systems, Jupiter wagons. These are the manufacturers that supply trains, wagons, and coaches. Evaluate like a manufacturing companies. OB divided by revenue ratio plus EBITDA margin. Bemal just won 5.35 million addition to its Middle East export orders. International orders book now 1112.35 million. Yes, now in section 4, live demo, checking order book and margins on the screener.in. Open screener.in live, show how to find out order book data in most accessible place. Let me show you how to check these metrics for the BL IRFC in screener.in. This is free, takes 5 minutes, gives you more insight and than the most newspaper articles. Live demo of finding order book and valuation data on screener.in. Now type screener.in, Google browser, log into screener.in and come to this desktop of screener.in. Here we can search for a company. We'll search for BEL, Bharat Electronics Limited. Bharat Electronics Limited. Click this. Now you can see the data here, statistics of Bharat Electronics here. Now what you have to do is go to this profit and loss statement first. Check the sales revenue from March 22. It is increasing here. You can see now it is at 27,610 crores. It is improving every year. Now what you have to see is you have to see the quarterly reports. You can click on the quarters here. Every quarter you can see the revenue for every quarter here. Okay, March quarter to 2025 is 9,150 crores. June it has come down, and again September 25 it is slightly increased, and December 25 7,150 crores, and March 26 it is 10,224 crores. They are getting good orders due to this government's central government's defense spending. Okay, now we can see this what is the quarterly reports of May 26 here. If you click on the CI summary, you will get the reports. The performance of the BEL, Bharat Electronics Limited. Top line sales sustained. Operations rose 16% year after year to 27,480 crores. Profit before tax INR 8,075. This is plus 14%. Profit after tax 6,048 crores is also plus 14%. EBITDA margin 30%. EPS has increased to 808 rupees 27 paisa previously versus 7.23 rupees. Okay, they are getting good orders. Quantified major items management numbers, electronic fuses. 4,600 crores. C, LRSM, LCA 3,200 crores. BMP 2 upgraded 2,800 crores. Ashwini Radars 2,460. MI 17s 2,200 crores. Like this, they have got very good order book. Order in the pipeline. Large ticket defense programs explicitly called out. QRSAM, all the details are available here. You can see, go through leisurely and get updated about the BL. Knowledge yourself. So like this, you have to find out the order book of the company. Now what I suggest you is see IRFC. IRFC is a Indian Railway Financial Corporation. It is just like a bank company. You cannot get this order book and all. You have to access like a banking company only. Now I'll show you the one more RVNL, Railway Vikas Nigam Limited. Here, if you select this, same you will get it here. First you check on the quarters. How about the quarters figures? Quarters figures are very encouraging. From June 25 it is increasing. Now it is 6,696 crores. Then go to profit and loss. Here also the revenue, annual revenue for March 25 it is decreased. March 25 it has climbed up again. So we shall see the latest quarter results and latest quarter results given by the RVNL. Click on the CI summary at the bottom. You will get all these things. See order flows, order book strength. Standalone orders inflow is 4,644 crores. Quarter 4 and 5,875 crores for the financial year 26. Then order book for railways it is 57,000 crores. Signaling equipments 14,900 crores. Ports 10,419 crores. Metros 9,900 crores. And power transmissions 4,000 crores. Hydro and irrigation 2,000 crores. Like this, you can see everything, go in detail of everything about this company and update your knowledge. Like this, you have to see and update your knowledge before making any investment decision. Now in section number 6, the risk most investors ignore. Most important section for experienced. Most important section for the experienced investors. Risk transparency builds credibility. Every discussion on defense and railways must include the risk most investors ignore. Risk 1, execution risk. Risk 1, execution risk. HAL has a huge order book, but delivery of LCA, Tejas and other platforms has been consistently delayed. An order book that is not executed is not a revenue. Always check is revenue growing in line with the order book size, or if there is a significant execution gap. Then the risk number 2, valuation risk. In 2023 and 24, many defense stocks traded at 60 to 80 times earnings. That is euphoria pricing. Some have corrected 30 to 40% from peak. Even BL at 38 times financial year 28 estimates requires that the growth estimate is materialized. If the order book grows but margins slip, the PE multiple contacts and the price falls despite good order flow. Then risk number 3, the IRFC lesson, government backed does not mean safe. IRFC is 84.6% owned by the government of India. The underlying business risk is very low, but the stock fell 35.83% in year 1 from its peak valuation. Because of the market re-rated from the unreasonably high PE of 50 to 60 times, the more reasonable 17 times. Valuation contracts happens to the best business when they are overpriced. This is episode 26 makes mistake 1. Price is not the same business quality. Then risk number 4, policy risk. Change the government policies, change in government priorities. Even within the same government can shift which defense programs get funded. Always diversify with the sector. Do not put 30% of portfolio into a single defense company. Then section 7, your defense and railways action plan, complete framework, your action plan for the defense and railways in 4 episodes. Episode number 24, portfolio. Step number 1, identity, the category that each stock belongs to a lender, IRFC, project company RVNL, IRCON, or monopoly companies like IRCTC, or manufacturer like BEML. Then in the step number 2, apply the rate valuation tool, PB and ROE for IRFC, OB bar revenue for the project companies, consumer metrics for the IRCTC, OB and margin for the manufacturers. Then step number 3, run the episode 23 5 trap check, OCF versus profit, receivable days and interest coverage. These work for every sectors. Step number 4, check valuation history. Are you buying at a peak PE or after a correction? IRFC at 17 times today is different from IRFC 55 times in 2024. Step number 5, never concentrate on episode 24 said no single sector above 35%. Within the defense and the railways, no single company above 10% of the total portfolio. Where does defense and railways fit in the episode 19 sector map? Defense manufacturers, growth sector, high compounding, long visibility. IRFC, rate sensitive sector, valued like banks, sensitive to interest rate policies. IRCTC, different monopoly. IRCTC's defensive monopoly evaluated like FMCG. Comment below, which defense or railway sectors do you currently own? What is the OB divided by revenue ratio? I reply to every day and follow. Episode 28 is coming. Please subscribe, like and share with family and friends and support me for bringing more such good videos for you. And thanks for watching.